join us, yes, to talk about the performance of Barita and what's happening in the broader Jamaican economy, including Barita's long-term vision and what the future holds for the Jamaican financial sector. Good morning, Ramon Small Ferguson.
Good morning, Cliff. How are you?
I'm fine, and you?
I'm doing well. No complaints at all. Good to be here with you this morning.
Very well. Tell me, Barita is reporting very strong financial results. What would you say were the major drivers behind this performance?
Yeah, good opening question. Well, it was a bit of a mixed bag for us for last quarter and for the first half of our year in totality. All our business lines showed up during the period, so it was a diverse performance. Net interest income, for example, which is a core part of our performance, essentially looking at how our portfolio performed during the period, was up. And that's really driven by us managing our balance sheet very well during the period. We saw growth in our assets under management, so more investors would have put funds with us during the period, and that resulted in larger revenues from our asset management business. We would have seen our alternative investment exposures, and particularly our exposures to real estate, continue to perform during the period. And finally, in January, we would have closed on the acquisition of Jane Fund Managers Limited, which is now 100% owned subsidiary of Barita Investments Limited. And I can announce here, has actually been renamed Barita Fund Managers Limited. We would have closed on that acquisition in January, and we're seeing now the benefit of about 2.5 months or so of the performance of that entity in our financial results for the period. So very broad-based performance. Our revenue is diverse, and we're continuing to see strengthening of our franchise to the benefit of both our customers and by extension our shareholders. So happy about the performance here today.
So this performance, does it reflect more strategic execution or broader market conditions?
Yeah, that's a good question. So I mean, market conditions have certainly provided some support in some areas. So for Q1, we certainly had
and happy Thursday. Thank you for joining us today, and welcome to the Barita Beat, the pulse of our performance. I am Sansia Thompson, Vice President of Premium Wealth and Corporate Solutions, and I will serve as your moderator for today's earnings call. Joining me this afternoon are Ramon Small Ferguson, Chief Executive Officer of Barita Investments Limited and Managing Director of Barita Unit Trust Management Company Limited, who will provide insights on the group's outlook and strategic direction. Stephen Philibert, Group Chief Financial Officer. He will walk us through the group's financial performance, and Dane Broadbent, Acting Chief Executive Officer of Barita Merchant Bank Limited and Chief Executive Officer Designate of Barita Financial Group Limited, who will provide updates on business operations, strategy, governance, risk management, controls, and compliance. Also with us are Richard Williams, Interim Chief Executive Officer of Jane Fund Managers Limited, now Barita Fund Managers Limited, and Senior Vice President of Asset Management and Research at Barita Investments Limited, and he will speak to us about the macroeconomic environment and investment strategy. And we do have some first timers. So joining us on the Barita Beat for the very first time, and a very warm welcome, are Bernard Stucker, Chief Executive Officer, Real Estate Development, who will share updates on our real estate strategy, and Stefano D'Ambrosio, Chief Innovation Officer. Now, today's briefing will provide a comprehensive overview of our second quarter financial results for the period ending March 31st, 2026, which were published on the Jamaica Stock Exchange website on Friday, May 15th, 2026. We will also provide updates on key business initiatives, operational performance, and the group's outlook. Now, as customary, we will open the floor for questions following the presentations. Questions may be submitted at any time during the session using the Q&A feature on your screen. I will now invite our Group CFO, Stephen Philibert, to take us through the financials.
Okay, thank you very much, Sancio. Good afternoon, ladies and gentlemen. We'll move right into the presentation of the financial results. Okay, so what we have up first is a snapshot of key metrics from our second quarter. So this is not year to date, these are second quarter numbers. Starting with net operating revenue at 3.7 billion, that's up 72% from the second quarter last year, which was 2.2 billion. Net profit after tax, 1.2 billion, 87% up from 0.6 billion last year. Net interest income, 714 million, up over 200% relative to 213 million last year. Gain on investments, 1.9 billion, up just over 150% from 0.7 billion last year. Operating profit, 1.5 billion, up 56% roughly from 1 billion rounded last year's second quarter. We now have a look at the 6-month results, and it's not a complete P&L statement, so it wouldn't add completely down, but we just have the key line items. So net operating revenue at 4.9 billion, just about, over 3.6 in the 6-month comparative period last year. That's a change of 36%. Net interest income, we're seeing a strong improvement there to 937 million from 382, up about 145%. So we've been speaking about this improving trend in our net interest income based on the relaxation of the interest rate policy, both here as well as globally. Fees and commission income up to just over 2 billion from about 1.85 billion last year. That's up about 9%. Continues to grow steadily. Gain on investment activities, 1.87 billion, up from 1.25, about 1.25 billion. That's up about 50%. So we're also quite pleased with how that is trending. That has been predominantly driven by our gains on our real estate exposure. Operating expenses, we do have an increase there to 3.15 billion from just under 2 billion last year. That's up 60%. But it's notable that bears a difference, bears almost entirely to a non-cash capital adjustment that was made in relation to us making improvements to the core operating system that we intend to use in the future. And then earnings per share, $1.15, pardon me, from 98 cents last year, up about 17%, tracking with net profit after tax, 1.38 versus 1.18. So looking in a little more detail at the net operating revenue composition, we see in the pie chart over on the left, the main component set out there. So about 41% is fee and commission income, the largest component. Gain on investments, 38%. Net interest income, 19%, and then a small other. So we think what we're reflecting here is a fairly good mix and good diversity between revenue lines, and that has served us well in the fairly volatile and shifting macroeconomic circumstances that we've all seen over the past 5 years or thereabouts. We then have on the right-hand side a chart that shows you the gain relative to the prior year in the various items. So we have a gain of 555 million in net interest. Fees and commission income has gained by 165 million. And then the largest gain is under the gains on investments, which is $624 million up relative to last year. Now we have a small decline on FX and other, and the combination of those two line items, but it does not significantly detract from the improvements made in the other lines. On the expense side, so I made reference to that technology charge earlier. So that is predominantly driving the 3.2 billion in OPEX up 60%. Staff costs, you'll see there, 780 million is up only 3.5% year over year. So we're fairly pleased with the management of expenses once you've made adjustment for that one-off item. We have the efficiency ratio, which shows you both before and after that adjustment. So it's 64% prior to adjusting that one-off item out. And once you've adjusted it out, it's 46%, which compares with just under 55% last year. So it's actually tracking, netting out that item, tracking very much in the right direction. We'll also look at the balance sheet and capital. So we have total assets sitting at just under 180 billion, up 20% relative to September last year. Total liabilities at 142 billion. That's up 25% relative to last year end. Shareholders' equity is up 3.8% to 36.4 billion. And capital adequacy, which is a very key metric that we pay a lot of focus to, is sitting at 24.4%, reminding the audience that the minimum is 10%. So we're very far ahead of that, and the industry average is also shown there at 22.5%. So we're also pleased to note that we continue to be ahead of the industry as it relates to capital adequacy. And then lastly, we have another pie chart for you, just giving a sense of the asset composition. It is very heavily weighed towards our investment portfolio, which is a combination of the 65% sitting in our pledged assets, those being pledged in relation to our repo liabilities, and also the marketable securities, which we count as part of the investment securities item. So we frequently will reflect those two items added together and refer to them as the investment portfolio. We also have investment property sitting at 11%. That relates to a transaction that saw the purchase of an entity which contained a material piece of real estate. So we have now that more significant direct exposure to real estate. But it continues to be in keeping with what we've said about our interest in ensuring that we have good exposure to alternative investments. And then we have some other smaller line items. We have receivables, loans reflecting there at 4 and about 3% rounded, and then a catch-all for all the rest of the line items there. So I think that brings us to a close on the financial section. I'll now hand over to Richardo, who is going to take us through the macroeconomic context.
All right, thank you, Stephen, and good afternoon, shareholders. So, as usual, my leg of the relay this afternoon pertains to just setting the macro context and the investment strategy and kind of explaining why we're seeing the numbers that Stephen mentioned just now, and also just to signpost some of the various elements that Raman will go into further details in his presentation. So in terms of the macroeconomic environment, there are really four major forces that are shaping our outcomes just now. Those are general, central bank policies, economic growth, FX, which are peculiar in our type of environment, and interest rates generally. And each has had some kind of direct read-through to our balance sheet and our earnings posture. So let's just take a quick cycle through these main macro aggregates. The first really pertains to central bank policy and inflation. Those are critical items now, taking on enhanced significance given the geopolitical conflict that started between Iran and US at the latter part of February and escalated into most of March and April. We're now getting indications that we could see some de-escalation. But notwithstanding, there are concerns around inflation expectations becoming unanchored. And what that necessarily means is that central banks can begin or at least are posturing to start revising rates upwards again. As do recall the last time we spoke, we were talking about the possibility of the central bank getting into a rate cut type of environment. But the data have changed given this geopolitical type of conflict. And that is the dance that we have been doing over the last quarter. And I would say our results demonstrate that we have been quite nimble in navigating that environment. What the central bank has done thus far is that up to last week, they met and maintained the interest rate at the policy rate at 5.5%. And prior to that as well, they also maintained it at 5.5%. And again, they are reinforcing view that with the continued conflict, elevated oil prices, etc., we can see some cost to economic growth and also some elevated levels of inflation. So that is something that we're watching very carefully in the business and setting the strategies accordingly. Naturally, there is a consequence here to growth because we are now navigating this environment even as we are still recovering from the impact of Hurricane Melissa last year. So we have seen the data reported from the PIOJ. We're seeing anywhere between -1% to -2% shock in terms of economic growth going forward. And again, when we put this into context and perspective, we had a damaging hurricane last year, which exacted all north of 40% of nominal GDP. And now we're having this conflict. So to have economic contraction of -1% to possibly -2% is actually doing a bit better than we could have hoped for. And it speaks to the nature of the macroeconomic stability that we are enjoying. And consequently, this underpins some of the strategies that we are actually executing on. And it plays into some of the critical elements of our business, such as our real estate exposure, which provides a natural hedge to inflation. And that is why you're seeing the nature of the results that we're having, particularly on the investment gains side of the income statement. Naturally, the FX element of things would be critical. Again, we're a small island developing state. And to the extent that we have a sharp increase in oil prices, that will have an impact on the JMD to the USD rate of exchange. So the central bank, again, has been quite active in ensuring that there is order in the FX market, right? So again, given the nature of the external shock and the lingering effects of Hurricane Melissa, I think we're also quite pleased, I would say, in terms of the fair amount of stability that we're seeing in the FX market, and that is also coming through into the business. So we have made some tactical and strategic choices in terms of the design of our balance sheet, in terms of our, whether we are structurally long or short. The USD, we have made some choices around that, which has placed the business in a very good position, as you have seen in Stephen's numbers just now, right? And I mean, the Cambio remains a very good franchise here as it relates to the FX business. And finally, rates and markets. I mean, again, the BOJ has signaled its intent to maintain rates at current levels. Our outlook here really turns on whether this conflict de-escalates into the summer months. If that is the case, then we are of the view that inflation expectations will remain anchored. And at least the BOJ and other central banks are likely to maintain rates at these levels, possibly out into the end of the year, until the higher levels of oil prices eventually work their way through in terms of a downward movement, to the extent that the conflict becomes de-escalated. So that is our outlook here, where rates and markets are concerned, both locally and globally. So what does this really mean for us when we put all of this together? Roman will definitely get into the granularity of these, but at a macro perspective, how we're designing the business, there are really 4 critical areas. Earnings quality. We're not just designing the business to be episodic. And as you can see in all of the line items, we are a business firing on all cylinders. We have been very deliberate in introducing more recurring, stable elements of revenues by virtue of the growth in our fee income here, the acquisition of Jane Fund Managers. Now, BFML, Barita Fund Managers Limited, again, is an important and critical element of that strategy. So we want to have that convexity in the balance sheet, meaning that irrespective of the undulations in the economic cycle, we can perform. The balance sheet discipline, again, this is, we're looking at how we fund the business, prudent duration management, again, given our expectations for how interest rates will turn. All of this turns on ensuring that we have appropriate levels of capital. We've always maintained a very good, extremely good level of our capital adequacy ratio, as demonstrated there, currently at 24.4%. But also, importantly, ensuring that we have robust levels of liquidity, because when markets change at the drop of a dime, really, liquidity becomes very critical. It becomes your lifeblood, essentially. And so we're well positioned there as well. The third and final and the fourth elements of things here, again, are alternative investments thrust, our real estate business. We have done significantly well here, and Bernard will be giving us some further details on this as we ramp up into a different phase of the development. Again, this element of the business is a natural hedge to inflation. And we're going beyond just the natural hedge to actually engineer significantly more value out of this, as we move into the development phase of the business. And of course, FX and liquidity, again, are all macro aggregates that turn on the current conditions, and we continue to map these and manage them appropriately. So those colleagues, shareholders, explain the outcomes that we saw. And Raman will now get into the more minutiae of the strategies.
Thank you very much, Richardo. Good afternoon, fellow shareholders. It's always an honor and a pleasure for me to speak to you about our business. And this quarter, I do bring good news. I bring news of a strong performance, but importantly, a diversified performance, as both Stephen and Richardo alluded to, for both the quarter and our year to date. All right, so I'm going to talk a little bit about our strategy. And it's a good place to start to remind you about the 5 pillars that really underpin the thrust that myself and the management team, under the very enabling and also, proficient guidance of the board, are pursuing in your name as shareholders on behalf of you in this business. The first is business line optimization. Having built this very large platform, we have been focusing over the course of the last couple of financial years on really emphasizing on businesses that can generate the most effective risk-adjusted return, and in particular, generate the best recurring revenues for you as shareholders, right? So we've been really focusing on shaping the optimal revenue mix and profile in the business. That has seen us focusing heavily on fee-generative businesses, such as our investment banking business and our asset management business. And Richard spoke earlier about the effect that the acquisition of JN Fund Managers, now Barita Fund Managers, will have on moving us further along in the direction of having a greater weighting of asset management type revenues. Right? The second pillar is customer centricity. We've really been deepening our understanding of our clients, trying to focus more on delivering personalized services. And we have been investing in our tech capabilities to really expand the convenience that we bring to the market. And we're going to have a bit of a discussion about the group-wide thrust associated with that a little bit later in the presentation. Operating efficiency is also an underlining factor of our strategy. Right? We're really trying to push productivity, doing more with the same and delivering a better quality with the same. And automation is playing a role in that, really streamlining our execution across the board, right? And a big part of that is the expanded platform almost that having a group of financial services companies now creates. Amidst all of this, we have not neglected our focus on risk management and compliance, really continuing to strengthen our frameworks, doing all of this under the auspices of strong governance and also maintaining high standards from a regulatory perspective. Finally, inorganic expansion, given the significant and robust capital base that we would have built up in this business, has been a feature of our strategy for the last couple of years. And this year, we're happy to be able to report to you as shareholders that we have closed on an acquisition, as is visible. And now we're moving to the next phase of that process, having closed, to now integrate the platform into our overall group. Right? So that's the element of inorganic expansion that we are now pursuing, the integration element. Really, the strategy is focused on fortifying our resilience as a business, really increasing our agility through that improved productivity, creating sustainable value for you as shareholders through creating the same for our clients, and finally improving our earnings quality. Really, those are the outcomes that we're pursuing on your behalf, right? And a big part of that really will come from us taking advantage of scale. We have really grown this business from about $70 billion in total assets under management at the end of the 2018 financial year, just after Cornerstone took over, to now north of $500 billion in total assets under management now in financial year 2026. And the latest push in scale has come from the acquisition of Barita Fund Managers, formerly JN Fund Managers, right? Really, it's transformational for us in a sense, insofar as it has added to our earnings base, our revenue base for the 2 months that we've been able to book so far. It's brought that AUM over $500 billion. We started looking at this transaction very early last year, I think. It may have been even late the year before. And finally got to the point of consummation in January of this year. We have moved to rebrand the platform, which we would have announced formally today on the Jamaica Stock Exchange, to Barita Fund Managers Limited. And this entity is meant to be the dedicated asset management platform within our group, focused on the fiduciary management of client funds, right? So what we are really focused on now is integrating this with a focus on clients, naturally the team, and also really bringing broader capabilities to clients across our financial group. So clients of Barita Fund Managers, clients of Barita Investments, and clients of the Barita Financial Group as a whole. And Dean is going to talk about what that means shortly. So, when you think about scale, there are many things that you can get from scale, right? But what we are pursuing from scale is greater resilience and greater sustainability. So we are seeking to convert the scale to more recurring and continuous cash generative earnings within the business, right? And how we see that is through generating what we call more recurring revenue. And we have been doing that over the course of the last several years. Revenue that is more predictable from asset management, advisory, investment banking, pension fund management, really fee-based income, net interest income. And you're seeing robust growth in those areas in the results that we would have produced year to date. And if you look back at our results for last financial year, you would see measurable, demonstrable growth in those areas as well. We're also focused on deepening the product base across the platform, right? Sharing the spoils with our clients and by extension, expanding opportunities, mutually beneficial opportunities. So increase share of wallet by delivering increased value to our clients. Finally, we want to deepen our revenue base, right? So broaden contribution across what we describe as client-led and investment-led elements of our platform, right? Things more within our control, vis-a-vis things that are more towards the vagaries of market conditions, right? So continued diversification, having a more balanced earnings mix. Really, we see this larger platform as giving us an opportunity to deliver what we describe as a higher quality, more durable earnings mix in the business, right? That really is the picture of diversification, breadth, and really a picture of programmed execution in the context of our group. Now, the other thing that we're focused on doing in our strategy, certainly to the end of the year and beyond for the second half of the year, is making our balance sheet work harder, right? Our slogan is to make your money work for you. And we embody that both for our clients and for our shareholders, right? And we have a few elements of our strategy that are geared towards that. The first is monetizing elements of our balance sheet, so certain lower turnover exposures that are symptomatic of the business that we're in as securities dealers. We're focused on monetizing that and continuing to improve our liquidity, which is a central feature of our strategy. Richard mentioned that, right? It gives us flexibility. It allows us to be more resilient during challenging market periods. So that's at the center of our strategy. Naturally, we're going to recycle some of that liquidity and redeploy it into better yielding, more liquid assets, right? And that means that that capital is going to become more productive. We are focusing on optimizing our funding cost and our funding structure, right? So lower rates are in the market now. We're going to be repricing or continuing to reprice our liabilities and hopefully improve our net interest margin. And when you think about our funding structure generally, there are opportunities that our current capital structure presents. When you look at our balance sheet at $180 billion, roughly 6% of that is funded by wholesale or capital market type funding, right? And when you look at our counterparts, they have a lot of funding from bonds, preference shares, etc. Only 6% of our balance sheet is funded from those sources. So we have tremendous opportunities when we're looking at optimizing funding, improving our liquidity flexibility, and also enhancing the discipline associated with us deploying capital. That has also been a key feature of our strategy, and it's going to continue. We're only going to deploy capital where the returns are justified by the risk that we're taking, right? And that leads us to potentially stronger ROE. So you're talking about execution centered around more liquidity, more productivity, and more returns from the balance sheet, making it work harder. Right? The final element is really enhancing the platform to make it even more scalable. Right? So you start by taking advantage of the scale. We're now going to make this larger balance sheet work harder. And we are preparing this business to become even more scalable. So what does that mean? The first element of that is integration, integrating Barita fund managers into our operations, ensuring that we align ourselves with our clients, ensuring that our product mix is optimal, our distribution channels are free-flowing, and that governance plays a role across the board here, right? And really our expected outcome with respect to this is stronger platform economics. On the efficiency side of things, we expect to be able to replace duplication where we have it, whether it's technology, systems, etc., and simplify the workflow across our expanded platform, right? And that should translate to better cost discipline. From a technology perspective, I spoke earlier about the benefits of automation, straight-through processing, and the central outcome that we're looking for there from a client perspective is faster execution, greater convenience, less intervention from us in terms of problem solving, such that you can have a freer highway to run on when you are accessing our services. And finally, we need to maintain strong controls and risk and governance, right? And that's central to maintaining investor confidence, right? So, we see the next phase for this platform as being able to scale without a proportionate growth in cost, complexity, and execution risk. And with that, having given you some insight into what the future looks like for the business, I'm going to hand over to Dean to talk about what the future looks like in the context of our broader group strategy. Over to you, Dean.
All right. Thank you, Ramon. And good afternoon again, investors. So we've covered the financial performance and the macro context. So what I want to turn to now, as Ramon mentioned, is the group strategy. Now, over the next few slides, I want to walk you through some meaningful structural changes that we've made to the regulatory foundation, to how the group is organized, and to a couple of initiatives that I'll introduce that we think will matter a great deal going forward. Let's go forward. So, Barita Financial Group is now Jamaica's 8th licensed financial holding company under the consolidated supervisory framework of the Bank of Jamaica. Now, what that means in practice is that we now operate within a regulatory framework that requires a higher standard of group-led governance, capital management, and risk oversight. So that designation reflects the scale and complexity of what we've built, and importantly, the accountability that comes with it. So as part of this, we've established an independent group board with oversight of risk strategy and capital allocation across every entity, which is separate from the operating boards of Barita Investments, the Merchant Bank, Barita Fund Managers, and Barita Unit Trust. So risk and capital standards are assessed at the group level. So integrated risk management and consistent accountability are now embedded across the entire platform, of course, while maintaining the governance at the individual subsidiary level. Now, the reason this matters is that beyond the regulatory dimension, it formalizes the architecture for what I've often spoken about, our one group strategy. It gives us a foundation to run an integrated cross-entity, initiatives with full supervisory alignment, which is really the difference between operating as a collection of companies and operating as a true financial group. So this is the group as you would have known it, right? 4 entities, each with distinct capabilities. Barita Investments Limited on the securities and investment management side, Cornerstone Trust and Merchant Bank for deposit taking and general merchant banking, Barita Unit Trust Management for managing collective investment schemes, and Barita Fund Managers, newly added, bringing institutional scale to asset and pension management following the Jane Fund Managers acquisition, now Barita Fund Managers. So these are complementary platforms, each one performing a clear role. But as we move towards operating as a true financial group, particularly with the FHC designation now in place, the question became whether the brand architecture still matched the reality of how we operate and definitely the direction we want to go. So as part of that one group alignment, Cornerstone Trust and Merchant Bank now operates as Barita Merchant Bank. So the name has changed, but the license, the institution, the team, and every client relationship remains exactly as they are. Now, of course, the rationale is straightforward, right? I mean, we've been building an integrated platform, and the brand identity needed to reflect that. Clients engaging with the merchant bank should immediately recognize the connection to the wider Barita group. Same standards, same depth of capability, same relationship. Right? This was a BOJ approved process, and to be clear, the name change is not a merger. The merchant bank continues to operate the same licensed deposit taking institution with regulatory standing, same management and the same obligations to its clients. So let me show you what that transition looks like. So this is the group as it stands today. Barita Financial Group at the top with Barita Investments, Barita Merchant Bank, Barita Unit Trust Management, and Barita Fund Managers underneath. Every entity now carries the Barita name, and the structure reflects exactly how we actually operate and how we strive to operate. One group aligned around balance sheet optimization, customer centricity, efficiency, governance, and innovation. The structure and identity now match the strategy. And from an investor perspective, really a single brand compounding value across every entity is really a lot more optimal than separate identities competing for recognition. So this is what our structure is designed to deliver, and we'll talk a bit about the outcomes that we're looking for. So with the group now organized and branded as a single platform, the strategy is built, as I have mentioned in previous investor briefings, around two things that really reinforce each other: customer centricity and operational efficiency. On the customer side, again, the thinking here is straightforward. We have investment management, we have a merchant bank, we have fund management, collective schemes, all within the same group. So the client should be able to access all of that through a single unified relationship. So we're tailoring the experience standards for each segment around 4 key principles: expertise, accessibility, trust, and responsible evolution. Now, on the efficiency side, the logic is similar. We're consolidating best practices, streamlining how services reach our clients, and using technology to drive improvements both at the institutional level and within individual teams. So the important thing is that these goals aren't in tension. When you get the operating model right, the client experience and the cost structure both improve together. And that is what our structure that we're striving for is designed to deliver. Now, I want to introduce something that we're building within Barita Merchant Bank that we're genuinely excited about, right? So we're positioning Barita Merchant Bank as a digital-first banking platform, purpose-built to expand financial access, modernize payments, and extend the group's reach to new customer segments. Now, we're not ready to share the full detail yet. We'll have more to say in the coming weeks. But in the meantime, we have our Chief Innovation Officer with us, and that's no accident. But our platform is being designed around inclusion, simplicity, and integration within the broader group ecosystem. So it starts with the bank, eventually extends to the group, so eventually spanning from transactions to wealth. So you can continue to watch this space for more on that. So, as I typically do, I want to spend some time talking about capital because, again, it underpins everything that we've been discussing. 36.4 billion in shareholders' equity, capital adequacy at 24.4%, more than double FSC minimum, ahead of the industry average. And nearly a quarter of all the securities dealers' capital sits within this group. Now, this is not just a buffer. For us, it's a strategic asset. It's what made the Barita Fund Managers acquisition possible. It's what underpinned our alternative investment strategy. It's what gave us the ability to keep delivering through the rising rate environment while more traditional revenue sources were under pressure. Now, on the risk side, the architecture matches the capital strength. The 3 lines of defense, our enterprise risk framework, which was especially relevant during the elevated inflation and tighter liquidity. Experienced leadership across governance and control functions, and board-led training embedded as a standard practice. Now, the way where we think about it going forward is that deploying capital for growth and optimizing risk capacity are 2 sides of the same coin. Every exposure that draws on our capital and liquidity needs to carry the expectation of delivering the returns that justify it. I know Ramon would have spoken about that as part of how we ensure that our balance sheet works harder. So, again, as you think about Barita in the context of the financial group, I want you to continue to take away these 3 things. First is innovation. Again, we're organizing the group to structure and deliver continuous improvement and meet our clients where they're going, not just where they are. Second is risk management and risk capacity. We continue to maintain above average capital and strong operational resilience to our governance and control environment. And again, we view that capacity as a springboard for growth, not just a safety net. And the third is customer centricity. We are reorganizing our group around our customers, really, and building the systems and the culture that allows us to listen carefully, respond with purpose, and use the full depth of our expertise to exceed expectations across every interaction with the group. So these are the competencies we're embedded into the institution, and we believe that they're what will define the Barita Financial Group going forward. With that, I will hand over to Sansia temporarily.
Well, thank you so much, Dane, Stephen, Richardo, and Ramon for the insights you have shared and just breaking down for us our general performance. I want to remind, even though we have been getting a number of questions, continue to leave your questions in the chat. We are going to get to them in a few minutes. But also, before we get there, I'm going to invite Bernard, who is our Chief Executive Officer for Real Estate Development, and he will go through our real estate strategy.
Excellent. Thank you. Thank you, shareholders and investors, for having me here today. I'm very happy and excited to talk about our real estate strategy and about the journey that is ahead of us. Before we do that, let me allow myself to introduce myself to the team, to the shareholders, the group. I'm originally from Austria. I came to the United States like 20 years ago, spent most of my time in New York City. I have a degree in architecture and have certifications for leadership in environmental and energy design. I was doing executive education at Wharton. So it was a really interesting journey, basically, to transition from architecture into the real estate development field. During my time in New York City, I've worked for one of the largest real estate developers in the United States, related companies. I was part of the Hudson Yards development here on the west side of Manhattan. A project then that led me to the Caribbean is the Mandarin Oriental project that is currently going up in Grand Cayman. I was a project executive for Ariel Companies out of New York that is a developer for the Mandarin. And And after that, basically, I did a stint in the Middle East. I worked for the Crown Prince of Saudi Arabia to be part of the Vision 2030 to transform Saudi Arabia from an oil-based economy into an innovation and tourism-based economy. It was incredibly interesting experience, and I'm happy to bringing all of these global experiences here now to Jamaica and to Barita. I joined last year in October, and I'm very excited to present you now our first ideas about real estate. To give you a context of my experience, I shared a couple of selected projects with you. One of them is on the left side is Nolana. I was involved as a design director in designing that exclusive luxury living coastal community along the Gulf of Aqaba in Saudi Arabia. It's around for 3,000 residents. It was around 900 properties that we have designed here, and was all centered around a luxury super yacht marina with 120 berths. Another project that I just wanted to share with you was to give you an idea about our design, of my design aspirations and exposure, was a project called Epicon. The twin towers also along the Gulf of Aqaba, combination of luxury apartments and hotel suites. All of these projects are currently under construction. To go back to the project that I was involved in before I went to Saudi Arabia, again, it was the Mandarin Oriental, now going up in Grand Cayman, on the southern shore of Cayman, next to Bodentown. That's one of the highest end luxury hotels that is currently under construction in Grand Cayman, with around 90 keys and 40 condo units. And to go back to my time in New York, beautiful project that I was director of is the Quay Tower, basically in Brooklyn Bridge Park. It's around 125 high-end condo units in New York City. That's just a quick overview of projects that I was involved in. Now to talk about what we are doing here. What I came here to do is really, I wanted to lay out some of the mission drivers that kind of motivate you to bring all of this to Jamaica, and basically build that vision for the real estate development portfolio that we have currently under management at Barita. So why do we do what we do? I mean, we really want to create lasting values for investors. I mean, this is our main objective. We are a bank, we're a financial holding company. We want to make sure that our investors and shareholders are part of this journey, and that we generate a lasting value and returns for our investors. At the same time, what we need to is, we can only do this with the local community, and community is an extremely important aspect of how I see development, because we want to use what is the best and the brightest minds here on the island, and combine that really with international expertise in order to really transform Jamaica and create some exceptional sites and destinations that will stand out based on design excellence and the economic importance and vitality. And not least important, I think one of the most important things is the human experience, especially in that hospitality development realm. So we want to, as some of our mission drivers, certainly create value for our investors. We want to deliver strong risk-adjusted returns that are on an institutional grade assets, basically through really structured, disciplined, and transparent execution. One other mission is to elevate the Jamaica's real estate offerings now to a level that we have not seen on the island. I think with that, we want to contribute to Jamaica's long-term growth by unlocking the potential of underutilized sites and elevating the quality of the built environment and new experiences in that context of now hospitality and living. As I've mentioned, community empowerment is something that I'm really focused on, and I want to engage and employ and uplift basically local talent, contractors, and businesses, and really engage them into our development process. Then certainly my track record in design and development really stands for best in class. It started out with working for some of the best architects in this business. I just mentioned Richard Meyer or Skidmore, Owings and Merrill that I'd worked for. But the focus wherever I go is really trying to create the best in class qualities that differentiate our products from the competition. And I think here we have an enormous opportunity in Jamaica to bring global experience and qualities to this very unique Jamaican environment, and develop places where people like to live, to stay, and invest in. And none of that would be possible if we don't really take care of the environment. And I call this sustainable stewardship that not only goes basically to the environment, but also applies to the entire process of how we operate and how we act and how we ensure that economic, social, and environmental resilience is established now for generations to come. The vision that I have, that I bring to the table here, is certainly not short of a world-class ambition. And we want to bring this to the table, including Jamaican authenticity, reflecting really this belief in progress, excellence, and legacy building. We are representing an incredibly successful and strong brand, Cornerstone and Barita, and so we have a very clear responsibility to continue on that quality and on that understanding of the brand that was established here over the last years. And part of that entire journey and that vision is really creating this world-class developments by elevating Jamaica's development world and standards, by enriching the communities, engaging with them, and bringing them to the table, and delivering, at the end of the day, enduring values to our investors and shareholders. The key vision outline for me is really the redefining of excellence. Every project must elevate Jamaica's global perception through design, service, and delivery quality. My focus will be on integrating people and places. I think the connection with the community, with the local culture, and the enormously beautiful environment here is one of the biggest assets that we have. Sustainable prosperity is an approach to really create long-term value that balances the financial performance with the ecological and social impact. And in the context of now hospitality design, what I think is one of the most successful trends is really now bringing experience and emotion to this process, to our products, through spaces that we create, and we are connecting these spaces to the people that experience that. So I call it at some point, luxury in motion is really trying to elevate the environment around us and integrate experience points that elevate us, how we feel and how we experience the space. And as mentioned before, representing such a strong brand, we have to be in there and create a legacy basically for the company that we are developing this for Barita and Cornerstone. the core values, nothing we can do without really asking ourselves, why do we do this and how do we do this, right? So I think integrity is certainly one of our key values and principles. We always want to do the right thing. That's our way where we start out, and this is really our guideline of how we are managing these processes. Excellence will be the differentiator. We pursue the highest standards in everything we design, build, and deliver. And I think this will be then showcased in the quality of the projects that we are bringing alive. Innovation is incredibly important in that space, in the hospitality space, and also in the development and construction space. I think we want to think differently in how we do things and how we can build faster, smarter, and better. So we certainly have to go beyond methodologies that are currently on the island in that field of construction. And we're looking at really the modern methods of construction and see in how far we can elevate qualities and make sure we bring these to the table. Partnerships, we can only succeed together. Our approach is really a collective effort with all our partners, uniting that global experience with local knowledge, and that will provide us certainly with an outcome that will be different to what we have seen here delivered before. Sustainability is one of our key values. We don't build for the moment, we build for generations, and we design with nature and not against it. So resilience is a part of this entire discussion, and that's how we're gonna approach every single development. The value proposition now for our investors is really that we are set out to create world-class developments that redefine and reposition Jamaica standards in hospitality and residential design, combining that global expertise, authentic design that is rooted here in Jamaica, and disciplined execution to deliver these lasting values. Some of these key value proposition pillars are certainly a design-led, nature-led, experience-led approach. We want architecture and experience drive that demand, the differentiation, and the returns. We want to combine that with an approach to include and base our decisions on global standards, but still combine it with that local feel and soul. It's very important that we are still connected to the Jamaican culture and environment. This is the quality that we want to highlight and build up on. None of that I think we can do without strategic global partnerships. We are going to collaborate with world-class architects, designers, engineers, and then on the branding side with some of the best brands in the hospitality business. And that will attract then investors and give us confidence that we can engage with these operators. All of that has to be based in an understanding of that local market, the local and the kind of regional market in the Caribbean. We want to make sure that we grow responsibly, that our developments are future ready, and that we deliver long-time performance. All of that execution is based and grounded on a really institutional discipline, transparency, and compliance that we have to commit ourselves to. Just to give you a couple of ideas of where we are within this market, this is highlighting some of these competitive advantages that we have here in Jamaica compared to other regional markets. This is certainly only a snapshot, and it's certainly only discussing a couple of these aspects where we think we are bringing and have a certain advantage. So the development cost in Jamaica is historically lower than on some of the higher developed islands. It's around 25 to 30%. We can see this that's in the Bahamas, Barbados, or Cayman Islands is certainly way higher. Then tourism growth. We've seen that over the last couple of years, especially post-COVID, tourism growth and recovery here on the island is extremely strong. It's much stronger than on some of the other islands, and I think that just speaks to the quality of the destination and to the global brand. We know that we are extremely well connected here in Jamaica when it comes to airlifts, the flight connectivity, with currently 3 airports, and many of them are being renovated and expanded. And we have around 15 direct flights to US cities. The scaling potential is huge because we do have a lot of land to develop. Some of our properties are on the North Shore that I will share and introduce to you. So we have enormous amount of land available to really scale and bring larger scale developments here to Jamaica. The investment climate is very favorable, and the government is extremely supportive in developing and in supporting basically real estate development with different programs. To give you an idea now where we are with our projects, we have in total around 7 properties of around 2,000 acres of land. We have 3 properties here in Kingston. There's a very smaller industrial property at Ferry Pen. Then we have a site here at Harbour Street, and then at Lady Musgrave. These are the 3 Kingston properties that we want to develop as a priority. And then on the North Shore, we have Reggae Beach, Windsor Estate, Ruins at the Falls, and Greencastle. So I've broken this up basically in development sequences that gives us an idea of how we want to develop these properties, how we want to approach this. So the smaller ones here in Kingston, we certainly want to focus on and we want to deliver. One of our priorities is the site at Lady Musgrave. This will be a truly urban development. And the Harbour Street at the waterfront is something that we are looking at in connection now with the entire waterfront redevelopment to make sure that we program that in a sense. So I think I've laid this out in a development schedule now, and a design and development schedule now, you could say, for the next 3 to 4 years. Then if we go over to the North Shore, we have a kind of longer development delivery time, also purely given the size of the sites that we own and develop there. So Windsor Estate is around 100 acres, Reggae Beach is around 285 acres, Greencastle is 1,600 acres. So we also have to be very cognizant and strategic in how we are bringing products to the market that we are not necessarily competing with our own development projects. So this will be a very phased approach, clearly understanding the market opportunities and the risks. Now to share some of the sites, locations. They are certainly the highlight of this presentation. As I've mentioned, there is a site here that we want to develop in a truly urban mixed-use development, which will also headquarter then Cornerstone as a company. It will include a hotel, hospitality product with branded residential. Really interesting location in this golden triangle of New Kingston. And we can see it's extremely exposed, strategically exposed sites with 3 corners, and very excited to develop this site. It's around 2 acres in size. The next site here along the waterfront is Harbour Street, which is also known as the former ice factory. We have started, and you can see it on Lady Musgrave, we have started to actually demo all the existing buildings on both sides, Harbour Street and Lady Musgrave. At Harbour Street, we also had to remove asbestos. All of that has been cleared off, and both of the sites per the end of this month will be completely cleared off and demolished of the existing buildings. Harbor Street is an interesting site on the waterfront. I think there's a lot of potential to really think about programming this site, now also in context with the entire waterfront urban redevelopment. Site is about 2.8 acres and will be a mixed-use development. Now heading over to our properties on the North Shore, we have an estate that's called Landparts of Windsor Estate. It's around 100 acres. And we are now investigating in this kind of pre-development feasibility study phase, a master planned residential community with potentially a hospitality brand as a core anchor. But again, we will bring a brand to the table to kind of build out this purely an anchor. And from there, we're going to face different development phases on these sites than for residential products. Reggae Beach is a much larger site. It's probably one of the most beautiful beach properties that we have. It's in this beautiful cove with golden brown sand. I think many of you know this location. It's extremely beautiful coastal development land. As you can see, it's enormous. The way it stretches all the way inland. It's around 285 acres, 75 acres. And we're very excited there to bring a really truly leading hospitality brand to the table, and then from there develop a high-end residential community. Then two more sites on the North Shore. One is pretty much in the heart of Ocho Rios. It's called the Ruins at the Falls. It's around a 4-acre site. It's interesting. It's right in the middle between the cruise ship terminal and the way cruise ship passengers and tourists basically enter into Ocho Rios. It's a beautiful site with a waterfall and a small river, Turtle River, going through it. For there, we are investigating in this pre-development feasibility studies our hotel opportunity that is really focused on serving now the needs of Ocho Rios, which might be more business focused. Then the last one that I want to share with you is, I call it the pearl in our crown. This is really the Greencastle Estate. It's an enormously beautiful estate that stretches over 1,600 acres of prime greenfield development land or opportunities. It's an enormously beautiful site that raises up to 500 feet all the way in the back. So the topography is very, very diverse. And that site will be certainly a long-term development site. 1,600 acres is an enormous piece of land. So we have to be very careful in how we phase and master plan this site. But what we want to bring to the table here is solutions development program that really respects the beauty of the site, that are based on a exclusive eco-luxury wellness principles that are probably centered around a branded lifestyle and other amenities. To give you an idea again about a roadmap that we are pursuing here, the focus will be for this first 2 years now to deliver the Ferry Pen Industrial Park project as a warehouse. It's one of the first assets that we deliver, that are logistics-based warehouse, potentially storage, cold storage, data storage. We have to investigate these, but we are about to start the design process for this project. In the near term, again, are the sites here in Kingston at Lady Musgrave, Harbor Street, which Lady Musgrave, as mentioned before, will be that number one urban lifestyle destination here in New Kingston. Harbor Street, in connection with the master planning for the entire coastal redevelopment, will be also a mixed-use project. And then the sites Reggae Beach and Windsor, all within this kind of 3 to 5 years. Of course, the larger sites will potentially go longer than 5 years, but that's where we currently see the development schedule timeline. And then longer term is certainly Greencastle. It's 1,600 acres. And depending on if we see now for the Ruins at the Falls, a clear business case here in Ocho Rios, that project, we can either move forward or also have it within this 5-6 years of delivery timeframe. What we are doing now, in a sense of where we are on all of these, is really we are in this pre-development feasibility phase. We have started to prepare these sites. We have started to go in there and do geotech investigations that will inform us about the quality of the sites, the soil and rock quality, to make sure that we clearly understand what kind of building and foundation design we can have to execute on the sites. And most of this other pre-development and feasibility work is really focused on site surveys, understanding the sites, doing the geodechs, cleaning them up, and now taking them into our business and master planning phase. That's it. I hope that was helpful to give you an idea of where we currently stand, and I hand it back over to our moderator.
Thank you so much, Bernard. No, we have been getting a lot of questions, and we thank our guest here today. I'll start the first question, and I'll put this out to Ramon. Ramon, there is a question as it relates to the name change. Question here is, we have noticed that there is a change in the name for the Barita Group, Barita Financial Group, from Cornerstone Financial Group. What is the reason behind this?
That's an interesting question. There are a number of reasons why we would have opted to go with the Barita brand for the group. And the truth is that we had some optionality. I mean, Cornerstone is the ultimate parent company of the group. And when Cornerstone began its acquisition journey, first with the bank, I was renamed Cornerstone Trust and Merchant Bank, and then with Barita, one could certainly see a Cornerstone group emerging from that. But I mean, maybe I'll tell a little tale out of school, having been here for most of the Barita journey. The reason we have morphed into the Barita Financial Group actually came out of a promise that was made by our group's founder and CEO, Paul Simpson, to the founder of Barita Investments Limited, pre-Cornerstone acquiring Barita. I suspect it was part of those off-the-paper negotiations that he would at that time rename the bank under the Barita name. There are a few promises coming out of that. Another one that's quite visible was the expansion of the Barita Foundation. Sansi, I know you sit on that board. So the promise was to rename the bank at the appropriate time to Barita. My understanding is that apparently Mrs. Lewin represented to him that it was always her dream to own a bank. So with the evolution of our group now going beyond just a bank and a brokerage house to now a financial group that owns 3 securities dealers and a bank, as at this point in time, the natural inclination was to name the financial group the Barita Financial Group. So now the Barita name has evolved from being a household name for the last almost 5 decades in securities dealing, stock brokerage, wealth management, to being a full service financial group across banking, investment banking, wealth management, asset management, stock brokerage, a one-stop shop, the Barita Financial Group. So it came out of that promise that Paul made, and now we're here.
Okay, great. Thank you so much. I think this question may be for you as well, Ramon. How is Barita planning to maintain these good results in these geopolitical climate, given talks about a possible recession and rising operational costs?
That's a good question, right? So I can't promise anybody that I'm gonna maintain anything except ensuring that this business is around to serve its clients and deliver value to its shareholders, right? And how we're gonna do that? It's a good question. And what we have sought to do, and it came out in the presentation just now, and I hope previous presentations, is really make this business a business for all seasons. We have focused heavily since we have been in charge over the last now 8 years that the Cornerstone and related team have been at the table on fortifying this business to make it more resilient. We started out with investing and injecting significant capital across the group. Barita Investments benefited to the tune of almost $35 billion in permanent capital. Dane will tell you that the bank benefited to the tune of about $4.5 billion, Dane? $4.5 billion, which is, I mean, a number too large for me to recall, multiples of the capital that it started with, and is now, from a capital ratio perspective, the best capitalized bank in Jamaica, right? So we started out with fortifying the business in that way. We then moved to, as a complement, fortify the business with human capital. And I think most, if not all of us at the table here, were beneficiaries of that, having come into the group in some way, shape, or form to contribute to the management of that capital. We enveloped the financial capital and the human capital with governance. We strengthened the board and the systems governing the operations of the institutions. I think that is most apparent in terms of visibly with the movement in the corporate governance score of Barita from C, when we just took it over, to A, right? Having invested the capital, the people, the governance, we've invested heavily in the brand, we've invested heavily in our customers, and we have diversified our business lines. And that's what has made us resilient, much more resilient to perform under different conditions. Now, where's the evidence of that? When we came into this business in 18, 19, market was booming. Traditional sources of revenue for investment banks, for securities dealers, were at a peak. Net interest income was flowing. Market-related sources of revenue were doing very well. Interest rates were trending down. And our business did well too. Then came the pandemic, which really attacked many traditional sources of revenue. And during the pandemic, if you look at our 2020, 2021, 2022 results, they were also good because we were pursuing what we would describe as a counter-cyclical strategy at the time. We also built up, I'd say, the platform of our alternative investment portfolio, or the base of that portfolio during that time. And during the ensuing years, where interest rates moved up significantly and sharply, those exposures and other elements of diversification helped us to remain profitable, and beyond modestly so during the 23, 24 years, when, if you look across the market, there was value destruction in similar businesses, right? Come now, 25, 26, we have continued our thrust to diversify this business because we recognize that even though conditions may be easing a bit, and certainly not at the pace that we would have wanted, as Richard indicated, we have a very long runway in this business. Barita has been around 50 years, and we intend to do multiples of 50 years from here. So I'd say when you think about the performance of the business, you can look to the resilience, You can look to the people. You can look to the financial strength, the governance as being, and the diversification as being underpinning factors that will help us from quarter to quarter to put together many quarters to run that next 50 years and the 50 years thereafter. So that's what we're doing to make this business future-proof, to make it resilient, regardless of market conditions.
Great. Thank you so much, Ramon. Richardo, how soon will you have Barita Fund Manager's website up and running, allowing for that transition for current Jane Fund Managers Limited clients to have online access to their accounts?
Thanks for that, Sansia. So just a clarification, the Jane Fund Manager's website is still up and running, so clients have access there. The new website, which is going to be Barita Fund Managers Limited, is pretty much completed, and we're just going through the testing process now to ensure that there is no disruption when we cut over, to ensure there is high fidelity and continued services to our clients.
Great, thank you. I have another question for you, and this one is as it relates to our pension fund. The guest here wants to know how it is that they're able to access or participate in a pension scheme.
All right, so again, a very good question. I would hope that everybody who is listening, if you're not already part of a pension plan, you should definitely consider doing so, because it's a critical element of just maintaining one's dignity at one of the most vulnerable periods of each of our lives. And it actually underpins one of the primary reasons why we took this acquisition. Now, as it relates to getting involved in a pension program, we have one here at Barita, which is by Barita IRS, and there are different risk categories or portfolios within the IRS that you can actually sign up for. So definitely check that out, and we will be as the integration between Barita Fund Managers Limited and the BIL side gets into its mature phase, we anticipate that there will be a wider menu of pension-related type investment opportunities available. But for the moment, you can definitely sign up with the Barita IRS.
Great, thank you. This question came in several times, and I believe it's one of the questions that we get at every earnings call. And I'm sure Ramon is pretty much prepared to hear the question as it relates to dividend. But the question, I like how the person has coined this one. Will Barita be paying a beautiful dividend from the good results of your second quarter?
Yes, I'm used to this question, so I'll answer it in a similar way to how it was asked. Certainly, we are happy with the results that we would have generated in the second quarter and year to date. And I mean, really, these results belong to our shareholders and, of course, are made possible by the team and the clients who continue to put trust in us to serve them. So we create value for them, and by extension, that allows us to create value for our shareholders and our team members, right? That being said, as I say every quarter when this question is asked, the decision around paying a dividend rests squarely with the board, and the board benefits from recommendations from management, which really take into account a confluence of factors. Naturally, the profitability of the company is one such factor. We also take account of capital needs of the company, take account of market conditions, both present and prospective, right? And then we put all that together and apply scenarios to the circumstances of the company once any prospective dividend is paid, right? So we look at, in some cases, apocalyptic scenarios, and we say, listen, can the company survive having paid this dividend if the world appears to be ending? We've seen different versions of that over the last couple of decades, right? And once we are able to satisfy ourselves as management and able to satisfy the board, that's a prudent thing to do, to recommend the payment of a dividend, then it's done, right? Now, past is no perfect predictor of the future, but as you are aware, Barita has tended to reward its shareholders not only by virtue of the effects of our results on the stock price over various horizons, but by allowing them to participate in the earnings of the company via dividends. So we tend to pay dividends, provided that it is prudent to do so. So that's information that you can take in thinking about whether a beautiful, as quote unquote, dividend is coming. Right?
All right, thank you. Another question for you, Ramon. As traditional brokerage margins compress across the region, what does Barita believe will be its durable competitive advantage over the next decade?
A good question. The truth is that I guess what was said is brokerage margins are compressing across the region, right? But it's a global phenomenon. It isn't a Jamaica thing. It isn't a regional thing. It's globally, execution, which is typically what shops like us have been known for, access to the world of investments. It's kind of becoming commoditized. There are a lot of self-directed investment platforms now that cost very little to access. So, how firms like us have been surviving and thriving lies squarely in the strategy that we have been articulating quarter after quarter, year after year, which is expanding, creating breadth within their operations, and ensuring that they have a myriad of complementary and value-add services for their clients. And that's really what we have been doing over the last 8 years, really building capacity in the business to expand it effectively, to diversify, not for diversifying's sake, but going into areas that are both complementary and also areas that build resilience into the business, because some of them are negatively correlated, right? When one area is doing extremely well, the other may not be doing so well, right? So that has meant really deepening our capabilities in wealth management, deepening our capabilities in corporate finance and investment banking, expanding the base of our asset management business, so going after scale there, right? And really enhancing our ability to add value, advice, depth to the conversations that we have with our clients of all kinds. So I'd say as we look to the future, it's really about the model that we're building around recurring sources of revenue, that annuity type kind of business model, complemented by ensuring that we have strong client-related capabilities. So clients will continue to come to us because they know they can get differential value, whether it's differential returns, whether it's differential execution when it comes to the type of funding that they can get through our investment banking business. So ensuring that we continue to differentiate ourselves in the eyes of our clients. And the third thing I'd say is ensuring that our platform is as efficient as possible. What that means from a client perspective is that it is convenient, right? And they can access services consistently and easily. And what that means for us internally is that most of our things just run straight through and go from end to end without heavy manual intervention, right? And we streamline the busy work so that we can focus on that value add work, which is really going to be our differentiator.
Thank you so much. Now, this question is in relation to the post-Hurricane Melissa environment, where economic visibility remains limited. How are you assessing client behavior trends and mandate flows across investment management, wealth, and advisory activities? And what early indicators are you monitoring to determine whether client activity is stabilizing or whether there is further pressure ahead?
Well, that sounds like a question that probably Richard or myself and Dean should take. Richard, maybe you can talk about the macro. Dean, maybe you can take a group view, read those clients, and I'll maybe round out if there is anything else to say after that.
Oh yeah, man, sure. I'll make this very, very quick. So the the geopolitical environment obviously is one that is confounding, perplexing in many respects. But one of the very important things that we have to do in the financial markets is to look through the noise, as it were, and to think of the market as a kind of discounting machine. So if there is bad news on the horizon, you discount it, you effectively place a price on it, and then engage in your strategies accordingly. So what does that really mean is that there will be times when there is an apparent disconnect between what is happening in the real economy versus how the financial markets are performing. So what do I give a practical example of this? When the conflict between Iran and US broke out in February, the S&P sold down sharply, yields spike immediately as well. So the S&P went down by about 8%. And as soon as there was some news from the US president, to indicate that the conflict could be de-escalated and there could be a truce, we eventually saw a repricing. So I say all of that to say, year to date, the S&P 500 is actually up by 10% from that low in February, and so too is the main market locally, up by just under 6%, right? Even as the conflict is still ongoing. So as investment professionals, that is how we have to position. And there is a term in ice hockey to say, you don't go where the puck was, but you skate to where the puck is going. And our investment research team or investment professionals are always scanning the environment to see where exactly the next pockets of opportunities are. And some, globally, we're looking at that spill over into our environment is a continued fiscal spend that is evident both in the US, some places in Europe, and definitely in China. We're seeing effectively a new kind of industrialization going around, centering on this business of establishing supremacy in all things AI. So the US is spending north of $4 trillion building data centers, etc. Just last week, there was effectively a new order from the White House where the president established that everything related to AI data centers, etc., is are facilities of critical and national importance, and they don't have enough of them. What does that mean? It means that the trends that we're seeing in terms of the market performance there, the fiscal support on the ground, building out the infrastructure, will likely to continue, even as on the one hand, we see this conflict. Sometimes it looks like it's going to de-escalate. Sometimes it amplifies. But our job as investment professionals really is to look through the noise, see where the opportunities are, and to manage the business appropriately. And we see that basically along all of the line items in our business, as far as to construct the balance sheet in a way such that it works irrespective of where we are in the market cycle. So over to you, Dave.
Yeah, I mean, from a client perspective, when I think about the macro environment from a client flow or client perspective, again, we are here to serve the breadth of our clients' needs, right? And definitely from an investment management perspective, our job as we look to navigate the economic environment is really to ensure that we are giving the clients the reassurance that, based on the depth of expertise that we have, as Richard would have mentioned, that the clients' financial affairs are in order. One of the things that we generally speak to, and the way we consider our client portfolios and even our business is really around resilience, right? I mean, as much as we through our analysis look to anticipate what's going on in the market. Again, we focus on ensuring that from our client portfolios to our business itself, that we build resilience, because again, you can build the dexterity to avoid problems and to anticipate where the market is going. But again, a lot of the time, what is most important is the resilience to withstand them and the presence of mind to see the opportunities where they are, right? And Richard would have mentioned some of those. So that's typically how we think about client activity in these times.
Ramon, do you have anything to add?
I don't think I have much to add. So
Okay.
you can continue, Sansia.
That's fine. It seems as if we have already developed some interest following Bernard's presentation on the suite of real estate assets. This question is asking, are we now open for any bookings or reservations being accepted for residential developments? Don't know. Are we ready?
No, that's excellent. I'm so happy to hear that the excitement was spreading basically through our shareholders and investors. I think it's a really good question. As I've said, I think community is part of our development approach. We want people to be part of this journey wherever we can bring them along. So we're certainly very open to track that kind of level of interest on who wants to be part, who wants to invest with us, basically, who wants to show early interest in buying into some of these developments. I think as we are now really taking this from a pre-development phase into a development phase, I think we will establish like a communication open platform through our website that we can engage with that interest that is out there and guide people on the opportunities and on potential partnerships and investment opportunities as we are starting out the developments.
All right, thank you, Bernard. So stay tuned. When it is open to the market, we will let you know. You will see the advertisements going out. So I'm going to take this as our final question. It's a long one and it's a strategic one. So the question is, looking at the second half of the financial year 2026, what are 2 or maybe 3 things management considers most critical to delivering on the strategic agenda? And where do you see the greatest execution risk between now and the end of the year?
That one sounds like me. Yeah.
It is.
So the good thing is that I can draw back on my presentation for elements of the response. Right. So I spoke along 3 themes, really taking advantage of the scale, making the balance sheet work, and also really looking at efficiency. Right. And I'm going to kind of zone in on a couple of those. I think with respect to the scale opportunity that we have, the integration of our operations across Barita and Barita fund managers is going to be a critical component of what we need to deliver to the end of the year to really set the business up for future quarters and years. And I think that's a critical component of our strategy to year end. To complement that, just thinking about making the balance sheet work harder, the ideas that we have around optimizing our funding cost and structure, whether it's changing the funding mix or lowering the cost of funding to create more value from our balance sheet, that's another critical component of the strategy that we really need to execute on. And finally, when I think about efficiency, really streamlining our processes, reducing the level of busy work that we have, and enhancing the level of automation across our business is another component of the second half of the year strategy that we really need to execute on. Really where I see execution risk, it naturally comes down most significantly to what we're doing with the acquisition. There are many moving parts there, right? We're really trying to blend cultures. We're trying to ensure that we keep our clients on that side, the clients that we would have inherited, that we serve now, engaged around our business, our ideology, ensuring that we preserve continuity there. Really, there is a very strong harmony and nexus between the values and the business approach, interestingly, of Barita Investments and GN Fund Managers. It doesn't hurt that I would have spent maybe half of, or just under half of my career with the Jamaica National Group, right? And many other people at Barita Fund Managers, I would have worked alongside them. So that does help to, elements of that does help to de-risk the integration. But I'd say that's probably where we're paying most attention as management. We do think that we have strong mitigants to the various risks that are attendant to integrations of that nature. We're giving Richardo a lot of support. And as we all know, the Cornerstone Group was born and continues to grow out of acquisition. So, we know a thing or two, having benefited from learnings from our founder and group CEO, Paul. We know a thing or two about buying businesses. So despite the risk, I think we're well poised to mitigate them and do well and bring value, continue to bring value to our clients, our shareholders, and our team members.
Thank you so much, Ramon. I'm making one final check before we wrap up, if there are any final questions. All right, I believe that's it. Well, thank you so much, gentlemen. It was a pleasure serving as the only female here today. Ladies and gentlemen online, thank you once again for joining us today on today's edition of the Barita Beat. This afternoon's discussion reflects the continued evolution of Barita as a more integrated, agile, and forward-thinking financial services group supported by strong financial performance, disciplined execution, and a clear long-term strategy. Now, as we continue to strengthen our platforms across the investments, banking, wealth management, asset management, and real estate development, our focus remains on delivering greater value to our clients, shareholders, stakeholders through innovation, strategic growth, and operational excellence. We do appreciate your continued confidence and support as we execute on our vision for the future. Now, if you missed any part of today's session or would like to review the presentation in greater detail, please visit our website at barita.com/beat. On behalf of the entire team here at Barita, thank you for spending your afternoon with us. We look forward to connecting with you again. Have yourselves a good evening.
Hi guys, today the Barita Foundation is at the UWI Mona campus to catch up with a few of our past scholarship recipients. Let's go! What is the best part of campus life?
Just interactions with other people.
What is the worst part to you?